Hey guys, Mike with Financeable here. It's Friday, which means it's time to answer the weekly challenge question. By the way, if you like these videos and find them helpful, definitely hit the like button down below and subscribe. We have a lot more coming. Let's hop in here. So this week's question is an accretion dilution question, but it's a little bit of a twist on the traditional question. Normally we look at multiples, but here we're going to look at yields. It's a yield-based question, but as you'll see, it's kind of 6 of one, half dozen of the other. It's sort of a different version of the same type of question. So I'll show you how to answer this question this way. I'm also going to show you that you could actually shortcut the answer to this question, which I'll show you at the end. So the question that we're looking at here is we have a company X, that's buying company Y. Company Y has a price per share of $35, and they're generating, or they're expected to generate, $1.75 per share in earnings per share in the coming year. The deal is going to be funded with debt entirely, so company X is using debt to fund the deal, and the cost of that debt is 10% per year. Assume both companies have a 30% tax rate. The question we need to answer is whether or not this is an accretive or dilutive deal. So let's take a look here. Let's start by compiling the data that we have here. So we have data for company Y, so we know that the company trades at $35 a share. We know that they're going to generate earnings per share of $1.75. So from that information, we can see that this company has a 20 times PE ratio. Now we can flip the PE ratio. We can take 1 divided by the PE ratio to get to the implied equity yield. And in effect, the way to think about this is if I were an investor in this company, I would be generating a 5% yield on my investment every year in terms of net income or earnings per share, however you want to characterize it. But the short story is the yield to someone who buys the equity of the company is 5%. So that's what you earn if you buy the stock. Now, on the other side, this deal is being funded with debt that has a cost of 10% per year. But remember that the true cost of debt is the after-tax cost of debt, because the interest on debt, I should say, is tax deductible. So we plug in the 30% tax rate here and we say the true cost of this company's debt is 10% times 1 minus the 30% tax rate, or 7%. So in short, the cost of funding for the deal is 7%, and the yield that we're going to get on this investment is 5%. So let's work through whether or not this will be accretive or dilutive. So the yield on this investment is 5%, and the cost of funding is 7%. So net, we're actually generating a negative yield. So if the spread were positive, it would be an accretive deal. We're generating more of a return on our dollars than the cost of funding. If it were negative, though, as it is here, what it means is basically we're not generating enough of a return to overcome our cost of funding. So the answer to this week's question is that this deal is dilutive. Now, I said in the beginning that there was a way to kind of shortcut this. When I look at this question, I say, okay, very quickly, it's a 20 times PE, so it's a 5% return on my capital, and the pre-tax cost of debt is 10%. Well, if I'm generating 5 and my financing is at 10, there's no way, you don't have to go through the after-tax cost of debt, there's no way this is going to be an accretive deal. So you could very quickly say, after doing your PE math, that on the surface, this is not going to be an accretive deal, and in fact will be dilutive. So in short, this is a bit of a twist on a traditional accretion dilution question, and what we're really looking at here is, what's the yield that I'm generating relative to my cost of funding? So once again, there's a bunch of nuance you could throw in here to make this a little bit more complicated, but this is a common interview question, so I just wanted to show you how to tackle this, so hopefully it makes a little bit more sense now. As always, thank you so much for taking the time to check out these videos and for participating in the questions. If you find these videos helpful, definitely hit the like button down below and subscribe. We have a lot more coming. Hope you have a nice weekend, and take care.